Our next guest has been using the lumber to gold ratio to predict market movements, and he has been correct in many of his calls. We'll touch on this with Michael Gayed, portfolio manager at Toroso Investments. Michael, welcome back.
Yeah, and always a pleasure, David.
You were on exactly a month ago, and back then the lumber to gold ratio was peaking. So if you take a look at this chart here that we're showing to the audience, back around May, it was already topping. Now that, of course, is due to the fact that the lumber price has been skyrocketing all throughout this year, and the gold price has not. So since then, it's come back down to April levels. The lumber price, as you know, has fallen, and gold has more or less stabilized around the $1,900 an ounce level. It's climbed up since last we spoke. So, what are your updates on your views of the markets? What does this lower lumber to gold ratio mean for you as a market forecaster?
Yeah, so actually, I want to hit on a few things before addressing that, because you hit on words that are always kind of trigger points to me, which are calls on forecasting. I always say that forecasting is an impossibility. And that calls are identifying the mile marker, right, that you might crash. And some people would interpret when I was on last time that I was making a call on the cryptocurrency crash. There was a moment there in the prior segment where I was referencing lumber to gold as a leading indicator to cryptocurrencies taking it on the chin the hardest. And that pretty much happened. Lumber to gold peaked, started weakening, and then you saw this spectacular sell-off in Bitcoin and Dogecoin and all these areas. But it's not a call. It's me identifying conditions that favor an accident. Now, since then, lumber to gold has really collapsed pretty substantially. It's one of those things where you can argue that it's due for that kind of a breakdown, given how significant the run-up was to begin with, or it could be a broader signal that some weakness is coming into the picture, given other intermarket relationships that I track. Typically, prior to major crashes, corrections, and bear markets, lumber to gold is weak in advance of those high volatility periods. Happened in every single major crash and correction, even going back to 1987. If you go on my Twitter account at Lead Lag Report, you'll see there's a pinned tweet there where I prove that out. It's not open to debate. Now, given the behavior of lumber to gold here, you might think, well, it looks like we might be entering a crash, very soon. Maybe. But again, I go back to it's more about the conditions favoring the accident, not the accident itself. So maybe we are entering a risk-off period where there's an elevated type of risk here where stock could break down very substantially. I happen to think the probabilities are very tilted in that direction. That does not mean that it's going to happen. And that's a really, really important thing for people to consider, because I get people on Twitter saying, well, should I sell everything or should I short? It's like, no, that's not how I'm looking at this at all. You have to know if it's raining first to determine what course of action to take.
Mm-hmm. Okay, so what you're saying is basically, suppose it's cloudy outside, it might rain, or it might not. But when you look at the days when it is raining, it's always cloudy. That's basically what you're saying, right?
Exactly. And, right. And I think right. And on that point, I do think that a lot of people are confusing the sunlight for what's really happening. I do think we are living in the eye of the storm here.
Okay. So let's go back to the year indicator. It's gone up. Now it's come back down. What does this mean?
So look, I mean, I think it's funny because I put a tweet out a month or so ago when lumber started to break down. I said, I guess that means people's housing prices are going to start dropping, and then few understand this. And people were kind of joking about that, like, oh, that's correlation, not causation. But the average home has 16,000 board feet of lumber. Now, of course, sawmills are coming back online. Of course, supply is, and some of these bottlenecks are getting reduced. But if lumber keeps going down, that would actually suggest a slowdown in housing. And by the way, that's not inconsistent with other things that we're seeing in the marketplace here. You referenced gold. Gold is starting to outperform. Okay, why? Because it would suggest that there's some defensive, non-correlative type of demand in portfolios occurring in gold price movement. Small caps, which are consumer-oriented, are pretty weak relative to large caps. Consumer discretionary stocks have been substantially underperforming the S&P over the last 3 months or so. So you've got a lot of confirming factors that would suggest that consumer spending power is about to maybe take a hit. That would suggest that housing takes a little bit of a hit, or at least slows down in terms of the breakneck pace we've seen it, and lumber simply is reacting off of that. Again, that could mean that you have a risk-off period. It could mean that it's a risk-off period without a crash. Again, my point is that you have to pay attention to the weather.
Yeah, so one of the things you told me last time, about a month ago, was that when the lumber to gold ratio peaks, and it did, usually you were expecting it to mean revert, and it did. So you got that right. So you also told me that just because it's high, it doesn't mean the stocks are about to crash right away. That's an important key you've made. You did not say on air that stocks are going to crash right away. In fact, you told me that when the lumber to gold ratio is at an all-time high, you're expecting a little more market euphoria. It's not until it mean reverts that we could expect risk assets to slow down. Well, it's mean reverted now. You've made that correct call. Are risk assets about to also mean revert?
So it's important to note, right? Again, it's not just about lumber to gold. So I've put out these 5 different white papers on one of these different awards, and all the papers document leading indicators to risk. Lumber to gold is one of them. So are utilities against the market, and so are treasuries. The problem that I have with the notion that people say, well, this is just sort of a mean reversion moment in lumber. It doesn't mean anything for stocks. Is I would buy that if yields weren't dropping. 10-year treasuries topped around mid-March, right? There's other sort of deflationary pulses that are happening. Now, historically, if lumber to gold is a true signal, meaning it's not a false positive, meaning you slowed down entering the storm and you actually did have the accident, usually there's a little bit of a lag, somewhere between 2 to 4 weeks, but it can depend. I mean, in 2018, it happened 4 or 5 months before that latter part of 2018 when the markets really collapsed. With Lehman Brothers, it happened 2 weeks before. With 1987, it happened a full month before. Again, you don't know the exact moment it's going to happen, but then, again, you have to kind of prepare for it. So that lends itself to the question of what do you do about it, right? Because again, I'm not suggesting you short. I'm not suggesting you go into cash. There's a reason why every strategy is a function of not just the signal that you're following, but the opportunity set. Mm-hmm. How you execute on the signal is really quite important. Ideally, you want to have an opportunity set that allows you to be wrong in your signal, a false positive, and still make money. Well, treasuries give you that ability. Low beta sectors and stocks give you that ability. Shorting doesn't. Going cash doesn't, because if you're wrong in your signal, lumber to gold is weak, market doesn't go down, well, you lose money 1 for 1 because the market keeps going up. If you're in treasuries, however, at least you have a chance because it's not a perfect inverse correlation, right? So you and I have been through this. We talk to a lot of different people, and a lot of people make these kind of big macro calls, but they don't necessarily talk about how to execute on them. It's very purposeful when I talk about treasuries and low beta as a way to execute on risk-off conditions, because in the event that the risk-off does not result in a decline, at least you are not going through a decline in the same way.
Okay, so let's talk about the defensive sectors now. In the last month, gold has done quite well relative to its performance earlier in the year. Utilities have done well. What does this mean for the investor? Are the market participants getting a little bit anxious?
Yeah, so if we go back to sort of the original argument I made about gold, which is that it doesn't really correlate to anything, although even that's a little bit debatable. Gold tends to do well when inflation stays hot over 5% over a prolonged period of time, but even that the sample size is a little bit low, right? So, but if you look at gold as a diversifier, when you want diversifiers in a portfolio, you want it when you're towards the tail end of a bull market. When you want less diversifiers in a portfolio, pure beta, towards the tail end of a bear market. So gold is a diversifier. So if there's demand for gold that's picking up, that would suggest that there might be some quote unquote smart money that is seeing the value of diversification here, because we might be towards the tail end of this risk on move. So it makes sense to me that gold will continue to get a bid here, and that you'd probably see more and more reallocation into defensive areas. The broader market and the broader public, especially those that are very focused on the meme areas, they're probably not going to see it until it's way too late.
So you're expecting gold to continue taking off to the upside?
I think there's going to be residual demand either way. And I'm saying that, again, purely from the perspective that there is I think an increasing need to find diversifiers, and they are few and far between. Historically, your only real diversifiers are treasuries, the dollar, and gold. And I think that's, given that your opportunity set is limited, it's going to benefit.
What about on the lumber side, Michael? What can you make of this correction? Was it due primarily because of potential slowdown in the housing market, or do you think maybe prices have just run up too hot and it was time for a correction anyway?
Yeah, I mean, it's probably a combination of the two. I mean, there was clearly speculative mania going on there. But, it's funny because some people have said to me, well, when you think about a lumber to gold signal or any kind of quantitative metric, you've got to kind of take into account the fact that this was COVID. Okay, I mean, so it's a one-off because of COVID, but every single asset class movement has been a one-off since COVID, right? So to me, that's not really a valid argument. And if you're going to follow a rules-based signal, as I do with the lumber to gold relationship with the RORO ETF, as I do with utilities and treasuries in the ATAC rotation mutual fund that I'm the portfolio manager of, if you're going to follow a rules-based approach, you can't really editorialize it too much, right? You have to really kind of follow through and go, the only way you're going to know if it's a false signal is with hindsight. But you've got to follow every single signal. And, in the event that you're right, suddenly it's a home run.
Okay, let's walk through all these signals now and talk about your investments for Taroso. How you position, talk to us about RORO.
Yeah, no, I appreciate that. So, it's as you know, I published the lead lag report and I referenced some of these signals in that, and the RORO ETF uses the lumber to gold relationship. So, full disclosure, I have an incentive to talk about the signal, but it's also one that happens to be very appropriate given the move to begin with in lumber prices. So, the RORO ETF, and you can see that on our website, it's all public information, went risk off about 3 weeks ago or so. So it's been in treasuries and it's benefited from that trade. Obviously, volatility has not picked up. Now, this is an important point. Again, you don't know if there's a volatility pickup exactly when it occurs. Right? You don't know the mile marker, you might crash your car. So just because you've seen this lumber to gold collapse doesn't mean tomorrow you're going to see the stock market collapse. Right? People tend to think that it's like an immediate response reaction. There is a lag, and you don't know how long that lag is. Typically, it's not that long. But for all I know, maybe the stock market does keep going up. But my point is that the conditions are there for a surprise. And again, going back to, it's not just about lumber, utilities, treasuries also confirm. The other part of this is sort of market dynamics here, right? So put call ratios are pretty much near all-time lows. There's very little hedging. Yes, skew is quite high, so that would suggest the price of hedging is up, but the number of participants hedging is fairly low. Almost nobody's shorting because everyone's afraid of being the next target from Reddit, right? So you don't have this kind of counterbalancing act there. And then margin debt's at all-time highs. And I look at that and I say to myself, well, how the hell are people not more concerned about that for an air pocket, for some kind of, just from a sentiment perspective? When you have everything going in that direction, I always use this line, when the crowd thinks it knows an unknowable future, and all of those dynamics are aspects of that, right? The crowd thinking it knows an unknowable future. Well, then opportunity always exists. I'm betting the other way. Right. So, again, it doesn't mean you have to have a big decline, but the conditions are all there. Lumber to gold is one of the major ones. That's the one that's getting the most attention now. I think it's going to keep on breaking down substantially. I think actually gold is going to probably now start doing more of the heavy lift as far as that relationship continues to break down. But again, it's not just that. There's multiple confirming intermarket relationships here, which suggests it's time to play careful.
Okay, so Michael, you think the lumber to gold ratio is going to break down? How much lower could it break down to? Could it retrace possibly last year's lows? Like I'm looking at your chart, for example, it troughed around April 2020. That perfectly coincided, by the way, with the stock market crash following the start of the pandemic.
Yeah, it wouldn't surprise me for that ratio to go round trip. I have a video that I put out on Twitter of my father in the late 80s teaching a bunch of Merrill Lynch brokers at the time. He talks about the psychology of a chart, and it ends off with that idea that it's a round trip. It kind of goes back to the middle of the range. I wouldn't be surprised to see it give back essentially the third, fourth quarter of last year return. But again, if that happens, it would suggest that a lot of this reopening enthusiasm is probably over and extended. Yeah. And I go back to, I do think something is ridiculously wrong when nobody seems to believe that markets can go down and nobody seems to be hedging even a little bit against that possibility. This looks very classic to me. And as I like to say on Twitter, with hindsight, if a risk off does occur, if lumber to gold does give a true signal and you do have a crash or correction, we may look back and say that was pretty much an exquisite set of circumstances.
Okay. And suppose it does retrace that level, what would it mean for the markets? Because last time it did that, last time it troughed in April, the markets rebounded, the stock market saw a V-shaped recovery. So is it necessarily true that just because the lumber to gold ratio is low, that we might see a market crash? Right. So it's about the relative movement against gold from a rolling perspective, right? So it's not so much about the level, so to speak. So if you ended up having lumber to gold crater, and if it were a true signal, that would mean the market itself is cratering with a lag afterward. Lumber to gold presumably would also bottom in advance of then the market itself bottoming. Okay. All right. Very good. And generally speaking, when someone tries to time the market, I mean, how would you respond? If I were to tell you, Michael, I'm an analyst, I've done my research, I am very positive or convinced that the market will peak sometime around October this year, and after that, we're going to see a crash. What are some of the questions, the immediate questions you would have for me? How are you executing on it? Right? How are you, again, it goes back to what's your opportunity set? It's funny because a lot of the studies on market timing show that market timing doesn't work. I'm in total agreement. The reason why it doesn't work is because cash is the alternative for risk off, meaning you go into the asset or you go into cash. Well, cash doesn't allow you to have false signals. Doesn't allow you to have momentum. So if you're wrong in your signal, you miss out from a compound perspective because you're better off being all in. However, if you're in treasuries or low beta areas, that's a different type of situation.
So it's funny because with the mutual fund I run and the ETF RORO, some people think of it as market timing. I don't think of it like that at all. It's more just tilting where you are allocating to. If you're entering a risk-off period, which I think we will, given the way multiple relationships are playing out here, all that means is lower your exposure, your beta, stay invested, but not necessarily to the point where you can't sleep at night in the event that a decline and breakdown really does occur.
Okay. So at what point, what indicators would you look for that would reverse your position? Would you go in, that would make you go in high beta and take on more risk?
Yeah, and that would probably be the final phases of a what may be a bubble. I'm using that term purposely because some people say, I'm always bearish. And meanwhile, they forgot that March 31st on Seeking Alpha last year, I put out a piece titled "Why the COVID-19 Bubble is Coming." I was actually wildly bullish a week after the low. So what would make me think that it's going to reverse? If the signal's obviously reverse, so meaning lumber to gold ends up coming back and utilities start weakening again, small caps start rallying again. I just don't think it's going to happen anytime in the next month and a half because these things are so extended. But if that does break down, that would be sort of a final real push, and then maybe it does end up being a real late 90s type of blow off. Very possible.
And final question now, Michael. You said March 31st last year you were wildly bullish. Would you still use those words to describe your sentiment now, or perhaps into the next 4 weeks?
I would say I'm bullish on the continuous surprises that people tend to have on the downside, right? Because again, I just don't think anybody really is anticipating a major drop here, which is why it may happen.
Excellent. Well, it's a little bit less catchy than wildly bullish, but what's right is what's most important. Thank you very much for coming on the show today.
Thank you, David. Exquisite. Appreciate it.
And thank you for watching Kitco News. I'm David Lin.